Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. This is Abel Pacheco, your host for the Five Talents Podcast. We are super excited today because we have another amazing guest, Mr. Adam Doran. Adam, thanks a lot for joining, my friend. How's it going?
Thanks, man. Thank you for the strong intro, and it's going well. I'm in Kansas City today, so I might be a little cooler than you are down south in Texas, but it's a good day.
Yeah, I have a feeling that you're in a different climate over there, man. Well, thanks a lot for joining. I appreciate it. For those that don't know Adam, I'm gonna let really himself introduce his background because he has an amazing one. He's a wealth advisor, and I think I saw you in some kind of meetup or networking event or something that I was like, well, I'd like to learn more about you and what you're doing. And you had an amazing strategy, a capital strategy that allows investors to kind of take, life insurance or that kind of strategy and invest it in real estate while they're protecting their loved ones. And I go, well, this is pretty cool. We got to get Adam on the show and we got to talk a little bit more about, this capital strategy. So Adam, why don't you give us, just a real introduction? Tell us who you are, what you do, how you do it, and we'll just get into a great conversation here.
Yeah, thanks, Abel. Well, as far as who I am, I'm a real estate investor as well, just like the listeners on the show here, and been doing that since 2011. At the time I got into real estate in 2011, I was still a police officer. So I was a street cop for 16 years. And in 2011, got to a point where I think most of us do when we get into real estate. I was tired of living check to check, and I wanted to figure out how real wealth works and how to build real wealth. And so I started going to seminars, got into wholesaling, then started doing single family rentals through the Burr method. And during that time, came across this strategy that I'm going to share more about today, where it was called infinite banking using life insurance. And there's a lot of names that it's given, but basically how life insurance can not just be an expense, a line item expense on your budget, but it can actually be an asset, a tax-free asset that can be liquid and give you control over your capital to use your money today. So unlike the traditional retirement accounts, where you got to wait till you're 59 and a half, you can use your money today and you can make $1 do the work of multiple dollars. So it was pretty fascinating and something I learned a lot about, got into using that strategy myself in 2011 after learning more about it and researching it. And I was looking to get out of police work at that point.
Yeah, let me pause you there. You were a
Yeah.
police officer for 16 years, my friend?
Yep. Yep. Yep.
Wow.
And
Where at? What city?
I started in Dodge City, Kansas, and then spent the first 2 years of my career there and the last 14 years of my career in the Kansas City area, working at a suburban police department here on the Kansas side.
Wow. Well, thank you for all of the years of service. Like, same duty, protecting and serving, man. What type of police officer were you?
So I was just street cop. I did a couple of specialized roles. I served as a training officer and a driving instructor and the radar instructor, and did a hostage negotiator role for a while and a critical incident team member. So yeah, I did a lot of specialty roles, but always stayed on the street.
Yeah. Wow. That's there's some dangerous moments and stories, I'm sure.
Oh yeah, lots of stories.
Man, I've heard that the stress level and the as a police officer, divorce rate, the suicide rates, things like that, just really high. I mean, high stress, high, anxiety, I would imagine, just crazy moments. And tell us a little bit about what said, hey, what turned or triggered for you to say,
Yeah.
16 years, that's enough. I got to find something else.
Yeah, I am one of those statistics you mentioned earlier. During my time as a police officer, did have a marriage that ended in a divorce. So sadly, I'm one of
Mm,
those statistics. But no, 10 years into the career, I loved it initially. 10 years into the career, I had a family and was married and got tired of giving up nights, weekends, and holidays. And I felt like I should be making more money and that our family should be doing better. Our financial situation never seemed to improve. Even as I continued in the career, continued to have my pay raises every year and whatnot. It was like we couldn't keep up with inflation, market forces, whatever you want to call it. We just
yeah.
couldn't keep up, and so I wanted to fix that. And so it was
Yeah.
financially driven, really. And
And you're working so hard protecting and
yeah,
serving, but it's
yeah,
not a, six-figure job, correct?
yeah. Well, and when you start and you're young and single, and you don't have other family members that you're worried about taking care of and providing for, and that kind of thing,
Yeah.
it was a lot of fun in the beginning, the excitement of it, but eventually priorities changed, my focus shifted, and it was about how can I build something sustainable for my family and have more control over my life and my time.
Yeah.
And so, I knew I wanted to get into real estate investing, and I knew eventually I was going to get into a business of some sort where I
Yeah.
could, grow and scale my income. And
That's
I
cool.
landed in wealth advising. And a big part of it is because of that strategy, I would call an alternative strategy that I discovered where I could leverage life insurance into the real estate investing that I knew I was going to be doing anyway.
Yeah, that's
Um,
awesome. Let me and I want to let you go on that, but before I do, you've got such an like interesting and very relative background story, because I think many investors find real estate as the vehicle to invest in because of a lot of the same reasons, like trying to attain financial freedom. My priorities are changing, families, children, and I want to have a different lifestyle. So what was it that prompted you to take education, and what was that first piece of real estate education? You said
yep.
wholesaling and Burr, and like I don't want to skip over that real quick. what
Yeah.
what what was that, and what did you do, and how'd you do it?
Yeah. So I went to a Get Motivated seminar in downtown Kansas City, and I walked away with basically three major takeaways. One is that wealthy people own businesses, and I needed to learn about owning a business and figure out what business I was going to own.
Yep.
Wealthy people invest in real estate, and I needed to learn about real estate and how to invest in that. And wealthy people understand finance and how the markets work. And so I invested in learning about that. So there were a couple speakers on each of those specialty topics, and I started buying, the seminars they sell you at the seminar. And
Yeah.
so I bought the $99 real estate intro course, and then from there I bought a $14,000 mentoring package, and then I learned about tax liens and deeds, wholesaling, all these different strategies. And I basically settled on wholesaling and single family rentals as the way I was going to start my journey.
Gotcha, man. That's awesome. um let me just dig in here for a minute, because so many people would take that class or course, or maybe not even go. They see 99 bucks, man. They just want my money. They're just trying to get as many people to sign up for their classes as possible,
Yeah.
which I don't disagree that there's probably companies out there that do that. However, you taking a risk, a $99 risk, and signing up for the program, and then an even bigger risk, a 14K risk, led you to learn about these three strategies. And I'm glad I paused you, because wealthy people invest in businesses, real estate, and they learn about the financial markets, man. And so maybe if you wouldn't have spent the 99 to invest in yourself, you may not have had the next bit of education and built on it. And that's awesome, man. So
Yeah.
kudos to
Yeah.
you. So what what was your I guess the lifestyle? Was it supportive to taking education then? Was it super hard? Did you have to grind nights and weekends? Like, how did you even
Yeah.
find time to take the education, take the course, implement the strategy?
So at that time, I was 10 years into my career, and in public service, usually you get decent vacation time built up. So I burned a lot of vacation doing business trips, and my
Yeah.
vacations were business trips. So I would go to Dallas for a class or Orlando for a class, and it would kind of double as a a vacation where I could see a new part of the country, and I could write it off because I was there for business purposes to do professional development and education and learn how to build my business. So it worked out pretty
Nice.
well.
Nice. We had very similar, although I was not a law enforcement officer, a street cop like you, and I didn't have the same stress and pressure, and my life technically was not on the line. I had a W-2 full-time job, and that's what I did too. Burned my Thursday, Friday, and then
Yep.
it bled into Saturday, Sunday. And we went to all
Yeah.
kinds of different cities, so we had very much similar background. And that, so this was all in 2011.
So that's when I got started. And then the learning process, the seminars and the selling properties through wholesaling and buying single family rentals, that was, over 2011, 12, 13, 14, 15. And I'm still somewhat of a seminar junkie today. I mean, I always try to work on professional and personal development all the time. So
Yeah.
obviously in today's environment with the pandemic, there's a lot more of that online instead of in person, but still try to do it.
Absolutely. It's your best investment is the one that you can put in yourself.
Absolutely.
And no one's ever going to take away education and knowledge once you have it, my friend.
Yep.
So that's, I agree. I agree. Okay. So you did a number of deals for a number of years, and then, tell me about what was next in your agenda. Was it, maybe transactions or deals? How many did you do? And then, how did you kind of go on to where you're at?
So, and in the middle of this, I'm starting this real estate business. I'm wholesaling. And then I went through a divorce, which kind of cleaned my clock financially. It really set me back probably 10 or 15 years in my financial progress. So my wholesaling ended up funding a lot of that. But the point was taken that I was earning more money than what I'd ever received compensation for in my W-2 job. And then as we were starting to accumulate, single family rentals that I was financing in creative ways, like using a private lender and credit cards at 0% to buy the property and then fix it up. And then once we got it rented, we'd go to the bank and refi. It was like, there was just these cool things that I'd never been taught before. And I was like, I'm really building assets and I'm really creating extra income. And so it just brought home the potential of what this can do for you. So numbers wise, I want to address that. I did somewhere between 60 and 70 wholesale deals in the Kansas City area and abroad.
There's a lot of transactions, man.
Well, but it was over about a 4-year period while I accumulated those single family rentals. So, I mean, I obviously wasn't doing it full time. I was, working it in the hours I could outside of work.
Yep.
I did lose a lot of sleep during that time. I was working night shift at the police department and then, doing wholesales and then trying to go pick up single families. I built a portfolio of about 5 single family rental properties. And then my partnership ended up not working out real well. So we started selling them off in 2015. And as we started selling them off, ended up having a lump sum of change sitting there. And in 2019, had a friend in multifamily approach me with an opportunity here in Kansas City. And so I became a limited partner in a 52 unit deal here in Kansas City. And so made the transition to multifamily relatively recently here, about a year and a half ago.
That's awesome.
And absolutely love that space. I love being a limited partner.
Yeah.
I love the work that I do full time. Like, I'm not miserable at my job anymore. I get to make my own schedule. I love being a wealth advisor, specializing in serving real estate investors. And I'm able to scale my income as I, build and grow and have more clients. And that then increases the capital available to go do the next real estate deal. And so I see real estate continuing to be a cornerstone for me as far as our family's wealth plan. And then coupling that with this strategy where the life insurance is also a cornerstone piece of that wealth plan.
Yeah.
And then the business is where, the active efforts create active income to, fund the rest of the plan.
Yeah, I love it. I love it. All of it, man. Congratulations on your first 52 unit,
Thank you.
Apartment buildings. And for those, that are just kind of catching this, if you're watching it live, right? Five Talents Podcast, we are really focused on commercial real estate. That's what we do. A lot of investors that I interview have started with single family and some wholesaling or liens or BRRRR strategy or flips or all the different strategies. But everyone that I interview on our show anyways, it definitely has had their hands in commercial real estate in multifamily apartment complexes or another commercial asset. And there's just the power of scale, the size, and then the ability to do a syndication, which is, I can't, there's, what's it called? I don't know, for anybody watching that's like, well, does Abel buy a $10 million deal like on his own? Does he have like 10 million bucks? And the answer is no. I can't afford to buy a building on my own. So what we do is we syndicate it. We pull a bunch of partners together. We raise capital and we go buy something bigger than what we would have been able to buy on our own. And that allows us to buy a bigger, better asset, a better vehicle that we can make more money in less time, which creates more time anyway. So that is the gist of multifamily syndications. And so Adam was like, hey, I think, you saw some light and I'm excited about it. So you got to invest passively. And the way I understand it is you did that with some life insurance or capital strategy that allowed you to go do that. Is that correct?
Yeah. Yep.
Okay.
And so
Here's the meat. Here's the meat for those. Oh, sorry.
Yeah.
I'm a bad interrupter, Adam. I apologize.
It's okay.
I would get your pen and piece of paper. Do this now. If you haven't already, this is the meat of the topic, which I think Adam's going to help kind of illuminate this stuff. So tell us about, this strategy, brother.
Sure. Well, if you're a real estate investor and you stick with that and you do it successfully, you eventually have what I would call a good problem. And that good problem is you have extra lump sums of cash that end up sitting around looking for a home. That money is looking for the next deal, the next opportunity. And the traditional places where we have to store that money generally don't either protect us and insulate us from things like rising tax rates or creditors or market volatility. And if there is some of those protections built in, like in a traditional retirement account, then the flip side of that is there's maybe not a lot of liquidity. Sure, you can have a self-directed retirement account where you're investing in real estate, but there's no liquidity up until age 59 and a half. You don't get to touch that money or benefit from that money until that point, unless you want to pay penalties and taxes. So, as I was learning of this strategy myself back in 2011, I was just thinking of, well, okay, what are the places I put cash? When we're in between deals, where am I going to put my cash? And it was pretty much, well, there's the business checking account, the business savings account, there's a CD. Of course, you don't want to do that because you lock your money up. And of course, those interest rates aren't competitive. Neither are the interest rates in a savings account or a checking account if it pays any interest. And then there's like a brokerage account where you trade money. You can trade stocks and options. And I know some investors that like to do that between their deals. The only, downside to that is you're taking risk with that money. And if you lose 30% on a trade or something like that, and then the next opportunity comes along, well, you could have played a month ago, but now you can't because you're down 30%. So, just trying to find a solution for where to store capital or warehouse capital in between opportunities and have the account be productive and not have to worry about loss. And so that's what kind of were the big takeaways for me as I was, studying on this strategy. But the other thing is, like you said, Abel, at the beginning, there's a death benefit attached to this account as well. So your money leverages up. If you die early, we'll say, your money leverages up. So if you're not around to complete your 30-year financial plan, well, there's a death benefit in there as well as a kicker for your family. So, those are kind of the fundamentals of why even look at life insurance as a capital strategy. Now, there's a lot about it that, depending on where you've researched and who you've listened to, there's a stigma sometimes around whole life insurance.
They say, don't go whole life, get term.
Yeah.
And
buy term
then they say, whole life is so much more expensive. Like I can get a term for a little bit of money, right? And that's one version of I guess the story, right?
Yep. Well, and it is in its purest form, that's a true statement in that, if I want to buy $1 million death benefit for purposes of life insurance, that $1 million death benefit can be purchased much more cheaply through term insurance than through whole life insurance. That's for sure. You're going to pay 5 to 10 times as much for that death benefit. But the thing is, a traditional whole life policy isn't going to be optimized as a capital account. So you could shovel money into that thing for 3 years and still have no cash value available to use and to leverage.
The moment you stop paying for it in term, you have no more, there's no more benefit
Right,
whatsoever,
right.
whether that's
And
5 years, 10 years, or 20 years, right? I just put money,
correct,
even though a smaller amount, I'm putting 200, I'm tuning 200, 2,400 a year, yada, yada. Okay, go ahead.
correct. So, but even not even thinking of term insurance, because what you mentioned is absolutely accurate. Term insurance expires worthless, and unless you die, and then of course you're not benefiting from it. Your family is. But with whole life insurance, there's a right way and a wrong way to structure it if you want to use it as a capital account.
Perfect.
And the traditional conversation is you go into the insurance shop and the agent says, how much death benefit do you need? Or they help you calculate that based on income replacement, sending the kids to college, et cetera, et cetera. And then you're trying to buy the most death benefit you can buy for the least amount of dollars. And that is a pure, line item expense in your budget as an insurance cost. Versus we turn that model on its head at Prevail, which is the firm I work at. And it's about building a cash asset where we want to store cash and we're going to put a life insurance wrapper around it. So we're going to buy the least amount of death benefit that the IRS requires and put the most amount of cash we can stuff into that death benefit. And what we'll do is create a tax-free account that essentially gives us all the perks that a Roth would give us. We can have tax-free access to money, tax-free income in retirement, but none of the limitations. There is no, you can't touch your money till you're 59 and a half. There is no reporting to the IRS. You're not capped out at 6,000 a year contributions, or if you make too much money, you can't do it. We don't have to worry about any of those limitations. And then we can take and turn around and, okay, we were going to build the real estate portfolio anyway. Let's store the cash over here in the policy. We will earn a internal rate of return in that policy that's going to average somewhere between 4 and 5% tax-free over the life of the policy. And then we're going to deploy that cash out into our real estate deals, and that's really where we're going to get our returns. So
Gotcha.
now I can make $1 do the work of two because I've got it earning interest in the policy, and I can deploy it out and simultaneously earn a return in the real estate investment.
Mm-hmm.
So I want to hit back on that real quick because that's a really important point that distinguishes this against any other capital account out there.
Mm-hmm.
If you have, let's say you could find a savings account today that pays 4%. If you had $100,000 in there and you took the money out to go do a real estate deal, you're now earning 4% on zero in the account because you've deployed the money into the real estate deal.
Yeah, it's no longer there. Just in case you didn't catch that.
Within a policy, if I have a cash value of $100,000 and I leverage that out with a policy loan and go do a real estate deal, I'm still earning the 4% on the $100,000 in the policy, and I'm now earning a return in the real estate deal.
Okay, so let's just pause here to break this down because this is the really cool nugget. So if I set this up correctly, and let's say I put 100K in it, it took me 5 years or 10 years, or I just stuffed it all in 1 year, right? If I have that in there, now 100K is earning at 4 to 6% IRR?
They're going to average 4 to 5% IRR over the life of the policy.
Over the life of the policy. So let's just say it earns some money and it's there, it's doing its thing. It's not quite, the gold standard is what I say is the rule of 72, which means in 72 months, you're at 16% compounded interest, your money doubles. 100K in earns 200K in 6 years.
Right.
So it's not the rule of 72, not that gold standard. However, my money's in and I literally pull it out to go invest in another deal, but my money's still earning the 4% or 4 to 5% average over here. Yep. And I'm invested in like for your case, a 52 unit apartment complex, which is probably earning 16%. So now I am hitting that golden standard because my money's working in two different spots. Is that right?
Yes. And I would say too, I think this is important to hit on. We've said a little bit about interest rates. Yep. I'm going to tell you, if you cycle through the cash in your policy, the internal rate of return is irrelevant. And here's why it's irrelevant. It doesn't matter. This isn't an account for growth. This is not going to create sexy returns where, you're not investing in this. It is a place to park capital with guaranteed upside and no risk of downside. with total liquidity so that you can do deals when they come along. And that's where you earn your returns. It's also
Gotcha.
where you take your risk. So this is not something to look at and evaluate based on an interest rate. It's what are my options for a place that I can park money and I can insulate it from market volatility. I can insulate it from creditors. I can insulate it from rising tax rates. And the account stays productive whether I'm using the money or I'm not. That's what it's about. So it's part of an overall strategy. If you are a totally passive investor who is not in real estate, this likely isn't a fit for you because you need to put your money somewhere it can grow better.
Yeah.
But if
Yeah.
you're
Yeah.
somebody who's actively using your capital as far as a place to park money, I can't think of a better vehicle.
Understood. Hello, hello. You're listening to the Five Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review and we're going to send you a free copy. So thank you so much for subscribing to the Five Talents Podcast. We really appreciate it. This is the part to illuminate for somebody that's listening, that's not investing in real estate, that's not putting this active capital that you've just created, whether it's a deal goes full cycle and you get your money back, or a flip or a wholesale or whatever those cash events are that you have. Don't put them in a bank account, put them in something like this. That'll allow us to, like you said, reduce the risk of loss with some upside. And I'm going to move it in and out, in and out, in
That's
and
right.
out,
That's
and
right.
still get covered, technically life insurance, the benefit, right?
Yes. And that's the other thing when you think about family legacy, and that's not on everybody's agenda, but a lot of the real estate investor clients I work for, family legacy is a big piece. They're building their portfolio, yes, for themselves, for passive income, so they can have some financial freedom. But down the line, they want that benefit to continue for family members. And life insurance is a very unique asset from a tax standpoint as well, because it will pass directly to your beneficiary, no going through probate, and it's a totally tax-free asset. So as far as legacy transfer, I can't think of a more tax-efficient vehicle to use.
That's awesome. And in this vehicle, and this is awesome, by the way, Adam, thank you very much for sharing. I appreciate your insight and knowledge. It's really awesome. So now let's talk about, the example, maybe a couple of different examples. I haven't started investing in real estate yet, but I've been holding my cash for a while, my 5 and 10 and 15, it's going to become 20. And I'm trying to save up to like $50,000 so that I can deploy into my first multifamily syndication. That's that example. I haven't done it, but I need like this. This was my savings account, was what I had been doing. And then maybe the other example is, no, this guy, somebody's been investing and they have cash. They have 100K today. Can I seed it all at once? Maybe those two paradigms. So there's people that are, haven't done it yet. And then somebody's like, I got 100K. Should I just feed it all into it at once? That would be awesome to hear those two parallels.
Yeah. So I have to be careful of absolutes and saying, here's what this person should do and here's what that person should do, because obviously everyone's situation is unique, right? But I want to try to give you and your listeners something tangible so you can feel like you've got some context as to how does this maybe fit into your world. So I'll give you an example of how I got started with my first policy. Mm-hmm. I knew I was going to be investing in real estate. I knew I was going to be accumulating capital to do that. And so this vehicle seemed like the smartest vehicle for me. So the way I decided to fund the first one was I had a car that I was finishing paying off. It was about $500 a month car payment. Once I finished paying it off, I'm already accustomed to that money going out, going out the door every month. Now I'm putting it into a productive asset. So that's how I funded my first policy. Now I have other clients who have, assets accumulated already where let's say there's $200,000 sitting in a checking account and it's going to go into a real estate deal. No, we can't just drop in the 200,000 and let it ride. We would need to phase it in strategically, probably over a 10-year period, so 20,000 a year. And there's a couple of reasons to do that. Number one, so that we can keep the life insurance policy tax-free. The IRS, kind of governs that we have to spread money in over a period of years. We can't just dump in a one-time amount and be done. That used to exist. It was called a single premium life policy. You can't do that anymore. Or you could, but the whole thing would be taxable and there wouldn't be near as much of a point to it. So we would phase it in probably over 10 years for something where it's an existing asset or an existing amount. But if you're just getting started, like what I was, I have clients that just get started with $400 or $500 a month. And then we have clients on the other end of the spectrum, wealthy and affluent, that they're doing 100,000 a year or more into a policy because they need a tax-free place where they can shovel money and they can't do a Roth IRA. So you could be anywhere on that spectrum. The other thing is, as far as structuring the policy, you can contribute to it for 10 years, 15, 20, till age 65, or mine goes all the way to age 100. And I figured the reason for that was by the time I'm in my 70s or 80s, I probably have enough passive income from my portfolio. I need a place to put money into the family legacy fund and know that it's going to be tax-free. And so I don't ever want to stop putting into that policy. I want to continue to fund it. Now, on the other hand, it has a dividend, and the dividend will be large enough at that point. It could carry the policy on its own if I decided to stop contributing. So there's a lot of flexibility as to how you structure these and how it looks for you. And it really comes down to having conversations with someone like me that can brainstorm with you about, okay, how does this fit into my world? And is it even a fit for me? And if it is, how much do I put into it? Because there's other things I'm doing too. I'm buying real estate. I might have a self-directed Roth. I might have a couple other things going. So we never want to put all our eggs in one basket. I just look at this as a foundational capital strategy. There's other things in your world you're going to be doing as well.
Yeah. Okay. That's good. Good advice. Good insight and advice. So, let me give you a couple of questions. And, I think some people, I know I've asked it in my head. There's probably other people that are thinking the same thing. So if I had 100K cash today, right now, how much could I actually put into it today and pull out like in 3 months or a year, or what kind of timelines do I have to wait for? And how quickly is it accessible? The rules, all the things that are probably, in this.
Yep. I'll give you the short answer on those. And then of course there's always a longer answer that we probably won't get to today, but I'm always happy to provide follow-ups for those that want to ask more questions later. So the short answer is, in year one, we can achieve, liquidity of anywhere between 30 and 70% of what you've put in year one. And that's going to be based on how you want this structured. There's actually a reason to structure it where you would only have 30% liquidity. And that would be if you're optimizing your policy for tax-free retirement income and you don't need to use the money in the first couple of years.
Mm-hmm.
On the other hand, if this is going to be your new primary savings account and capital strategy, then we'd probably, make the mix a little richer where, we could get up to that maybe 70% liquidity in year one. So that's your sliding scale there. As far as if I put in 100,000 this year, I'll have access to somewhere between 30 and 70,000, depending on how I build it in year one. Of course, as we get into the policy's life, the longer that it goes, the more we're going to have access to, where usually by the time we're 10 years into the policy, we have access to more money than we ever put in. And it continues to grow from there. So you can get to a point, 15, 20 years into the policy's life, for every dollar that you've put in, you're able to access and use $2, $3, $4, $5. Sorry for the background. My dog is scratching in the background.
Oh, good. Oh, good.
So that's what it looks like from the liquidity standpoint. And then I think there was a couple other prongs to your question I might have forgotten. So remind me if I didn't.
Even this is good though. This is good because it's an optimization. I want to set up, based on my goals, talk with you, advise me. I might tell you, hey, I just want to optimize for retirement cash flow. And somebody else may say, I want to use this as my bank account to invest in real estate and I want it as liquid as possible.
Right.
You know, kind of somebody like me, right? So if
Yep.
I put in 100K, I might have access to about 70% of it. Is that immediately, or is that I have to wait 6 months or a year?
Good question. So if you're contributing monthly premiums, so that 100,000 is spread over the first 12 months,
Yep.
well then obviously
Okay.
you'll have
Okay.
access to less because you put less in. Versus if you stroke the check for $100,000 and here's the year one contribution and dump it all in, then
Yep.
yes, right from day one.
Wow.
Otherwise,
That's
you're looking
yeah.
at building it over a period of months.
Okay, gotcha. And then every year on the, you know, the way that I think I heard you got started, which was $500 a month. You've got finished with the car payment. Just start getting after it. There's that number of years before it builds up some kind of, you know, a good amount to co-invest in. But now you can go invest. Once it comes back, you put it back in. You just kind of the dance begins back and forth, seeding it, pulling it, seeding it, pulling it.
Yeah, and just to give folks creative ideas, because if you're listening, you're like, well, shoot, you know, that 400 or 500 a month is really all I could do right now, and that would probably take a while to accumulate. Yes, it does. From experience, yes, it does. Here's what I did the first year. Once I had $1,000 in there, I started loaning my wholesaling buddies their earnest money, and I said, hey, don't take earnest money out of your checking account. I'll give you earnest money to use at 12% annualized, and you just get it back to me when you feel like it, whether it's a month from now or 6 months from now. Now, I'm not saying I recommend that. I'm just giving
Yeah,
you
that's
creative
what she
ideas.
did.
You
Yeah.
can use that money however you want. And just so that I could get the experience of cycling through the cash, I was doing little private microloans from year one. And of course, it's grown, from this point now I can use it as down payments on deals, or I can plop down a chunk into a syndication. But, that's it. Anything that you would use money out of your checking or savings for investment purposes, you could use this for. And it doesn't even have to be that. It could be purchases. My
Okay.
wife and I have talked about using a policy loan to fund a kitchen remodel in our house. And the way I look at that is that's a profitable investment. If we throw 10 grand into the kitchen and it increases the appraisal of the house by 30 or 40 grand, it was well worth it. So, I mean, there's a lot of ways you can use that money.
Yeah, that's awesome. Adam, the last kind of question or thought process is the tax benefit part of it.
Yes.
So just really quickly so that we get this.
Yep.
When you did that micro loan and that was a capital gain, the 12% or whatever, but you stuck it back. Where's the tax strategy in this also to avoid taxes? I'm sure there's
Yep.
some benefit here.
So it more has the tax strategy as far as avoiding taxes in the future has more to do with distribution from that policy. So
Okay.
the answer is yes. When I would take out a loan, I would then loan it out at 12% to a friend. So I would have to pay taxes on the interest they paid me because that's income I realized. Yes, that's true. Now, my policy, all the money that's in there, it continues to grow and accumulate because the policy has contractually guaranteed values that go up every year, and it pays a dividend every year. So it's growing and compounding. There's going to be a lot more in there than I ever put in. So there's gains. But similar to a Roth, as long as I take the money out the right way, it's tax-free and it's not reportable as income. And you can take policy loans in the later years of the policy's life and never pay them back. We always want to do this thoughtfully and be strategic about it, but you can take policy loans and never pay them back, use that as tax-free, non-reportable retirement income, and there's still a death benefit remaining later on. Like if you would, kick the bucket at age 90 and you were taking money out of that thing from age 70 or 75. So
yeah,
again, it's all about strategy, being thoughtful. It's something that certainly you'd want to consult and meet with whoever the advisor is that's helping you with it, but you can absolutely do that. And, frankly, tax-free money that you don't have to report to the IRS as income in retirement trumps money that you have in a 401k that you haven't paid taxes on, and the IRS is going to tell you how much you have to pay when you take it out.
No, I'm with you. I like it. Well, that's awesome. So Adam, thank you very much for your time. If our listeners, our audience network wants to get in touch with you, they want to meet with you, figure out a specific plan, what's the best place for them to reach out to you, and how do they contact you?
Well, thank you also, Abel, for the invite on the show today. I've really enjoyed being able to share this stuff. It's good good stuff. It's a powerful strategy. It has changed my family's life, and I want to help other people change their lives as well. So the best way to reach me is LinkedIn, because I'm on there daily. And I really ask if folks, and I'm the only Adam Doran on LinkedIn that I know of, or at least for sure the only one in Kansas City. And you'll be able to tell it's me. I've got the picture up there, and real estate investor and all that. So, but if you connect with me on LinkedIn, please just send a note. Hey, heard you on Abel's podcast or on the 5 Talents podcast. That way I'll know. And then happy to have conversations or just connect for networking as well. So I'm always, again, a fellow investor, and always happy to talk with others and brainstorm and mastermind on those things.
That's awesome. Well, Adam, thank you so much for your time. We sincerely appreciate it. It's been a good conversation. And I know a few people got some new strategies, maybe for some, and at least an extra thought about it. If you already knew about it, maybe it's an urge or a little prompt to go try it out. And, I just appreciate it. Appreciate your time, brother.
Thanks, Abel. This was great.
All right. Well, I'm Abel Pacheco. I'm your host for the 5 Talents podcast. If you're watching live, you're on Facebook, potentially you're maybe on YouTube. We've got a YouTube channel. And then I think most of our listeners are probably on Apple Podcasts or Google or Stitcher or Spotify, one of those two. We just appreciate you guys. I would encourage you, leave us a review, and a written review and rating would be awesome. And thank you so much. We hope you got some value from today. And I'm your host, Abel Pacheco. See you later. Talk to y'all soon. Thanks again, Adam.
You bet.
Thank you for listening to this episode of the 5 Talents podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who followed their dreams and achieved massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked, tell us your favorite guest, give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents podcast.